There are many mistakes an investor can make, and you can be sure that you will make some mistakes along the way. But there are some common mistakes we can list to help you hopefully minimize avoidable mistakes. Let's go through a quick overview of just a few. Not diversifying. Some investors hold very concentrated positions in only a handful of stocks. For example, someone putting 50% of their portfolio into a single company stock is taking a massive risk. If that one company goes under, 50% of your portfolio is gone. Diversification allows us to minimize company-specific risk. Home bias. Following from our last example, home bias, or home country bias, is when an investor places too much of their portfolio in their home country's stock markets. Canadian investors often have very large home biases. Some may only invest in Canadian stocks, even though Canada's stock markets represent less than 5% of the world's stock markets. Diversifying across markets from around the world can also help to manage the risk in your portfolio. Not understanding the investment you are making. If you come across an investing forum and people are getting excited about a particular company, it can be easy to become intrigued. But just because other people are hyped up about the stock doesn't mean it's a good investment. Do you understand why they are interested in the stock? Do those reasons make sense to you? Could you explain to a friend what that company does? If not, you may want to spend more time researching the company and its competitors and industry. Placing too many small trades. If you are placing many small trades, you might be paying more in fees than you need to. If the commission to place a trade is a high percentage of the overall trade value, you'll need to earn even higher returns to make that money back and turn a profit. Here's a quick example. To buy one share of a company trading at $50 per share, you would need $50 plus $9.95, or $59.95 in total. If the stock increased by 20% in value to $60 per share, and you sold it, and again paid $9.95 in commissions, you would end up with $50.05. So even though the stock increased in value by 20%, after factoring in costs, you actually lost money. You'd likely be better off waiting until you could place larger trades less often, or consider some commission-free ETFs or mutual funds or Smartfolio as more cost-effective solutions. Overlooking the downside. Investors need to prepare themselves for losses. A bear market is a 20% loss for a stock market overall from a previous high. And according to CNBC and Goldman Sachs, the average bear market on the S&P 500 since World War II and up until 2018 lasted an average of just over 13 months, and then subsequently took an average of just under 22 months to recover. Take that together, and that's 35 months, or almost 3 years on average, for an all-equity portfolio to see losses. Chasing performance. When many investors start, it's tempting to gravitate to what's been doing well lately. There are many different sub-asset classes of investments, and every year the ranking of performance changes in an unpredictable manner. Take a look at this periodic table of asset class returns. If we track any one asset class year after year, we see the relative performance is unpredictable. Let's trace the best performer in 2011, Canadian bonds, to see what happened the rest of this decade. It was a bottom half performer for the majority of the next 9 years. Let's look at 2012's best performer, emerging markets equities. The previous year they were near the bottom, but going forward, the performance ranking was all over the place too. Instead of focusing on the recent performance alone, we again see that diversifying across asset classes can help not only reduce risk, but also bring discipline to our investment process.